Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And today we're going to be talking about home financing, so both mortgages and mortgage refinancing. And this is an area where we tend to receive a lot of different questions. Things like, how much should I put down for a down payment? What type of mortgage should I get? Should I pay ahead or make the minimum payment? Should I refinance my mortgage, etc.? So our plan for today is to have a detailed discussion around all the different aspects of home financing and some of the common questions that go along with it. And this is a topic that's really relevant to all sorts of people across all different career stages. Whether you're a younger attending looking to buy your first home, or someone who's getting ready to retire and has already been paying on your existing mortgage for 20 years or more. And Andrew, it wasn't all that long ago that you and Jenny were going through the home buying process yourselves, so not sure if we're bringing back positive memories here, or if you're just happy you don't have to do it again anytime soon.
Oh yeah, so many fond memories there. But no, fortunately, I should be done with this process after I refinanced last year to a 2.375% rate on a 30-year mortgage.
Yeah, I still can't believe you got that interest rate. Well, at least the end result was good.
Yeah, no complaints here.
Well, let's jump into it. And why don't you start out by providing some basic background on home financing and the way it works from a bigger picture perspective?
Sure. So at a basic level, buying a home is typically the single biggest purchase someone will make in their lives. And because of the dollar value of it, most people can't pay for a home in cash. So you borrow money from a bank or a mortgage company in order to make the purchase. And most commonly, you'll pay a certain amount of money up front as a down payment, typically 20%, and then the bank will lend you the remainder of the money to buy the home. With your mortgage or the money you're borrowing, the exact details, like the interest rate and required monthly payments, will differ depending on the specifics of your situation. Some of these factors include how much money you put as a down payment, the size of the mortgage, the length of the loan, or also referred to as the term, and the type of loan, between variable or fixed. But the idea is that the bank is lending you money and the loan is backed by the value of the home. So you own the home, but if you stop making payments on your mortgage, the bank has the ability to take possession of the home and sell it to cover its losses. In return for the bank lending you money, you make monthly mortgage payments where each month a certain amount goes to paying interest and a certain amount goes to paying down principal, which reduces the loan balance. And eventually you pay the loan entirely and own the home outright. So that's a very brief and high-level overview to start around some of the basic concepts. So we'll dive a little deeper on one of the first factors to consider, which is the amount you put down.
Yeah, as Andrew just alluded to, when it comes to mortgages, there are a lot of different moving parts and different decisions to be made. So this can sometimes be a confusing topic. And one of the most common decisions or questions is how much to put down as a down payment. So we want to start by providing some color there. When it comes to down payments, the standard or traditional option is putting down 20%. So as a simple example, if the price of the home is $500,000, you'd pay 20% of that up front, $100,000, and borrow the remaining 80%, or $400,000. That being said, there are all sorts of options here. You could choose to put down more than 20% if you wanted, while on the flip side, there are mortgages that only require you to put down 5% or 10%, or in some cases, nothing at all. And physicians tend to have more options here, and there are even physician-specific mortgage products out there, often referred to as doctor loans, that require a smaller than normal down payment because the banks know that as a physician, you'll likely have an above average and fairly steady income, and therefore you're a lower risk borrower compared to the average person out there. As with most things in financial planning, the right approach to down payment comes down to balancing the quantitative side with the qualitative side. And as a general rule of thumb, we prefer the traditional 20% down payment for a few different reasons. One of them is the cost of the loan in terms of the interest rate you're paying. If you think about it from the bank's perspective, if you have two people buying the same house and one of them is putting down 20% while the other is only putting down 5%, the loan to the 5% person is riskier for the bank. The reason why is because the amount of the loan is higher relative to the value of the home, which provides less cushion for the bank if there was a period where home prices fell, which could result in the home being worth less than the loan amount, or if the borrower defaulted on their mortgage and the bank was forced to turn around and sell the home. This cushion, or the difference between the value of the home and the value of the loan, is referred to as equity. So because the 5% down payment loan is riskier for the bank will charge a higher interest rate to help compensate for that risk. And while the difference in interest rates isn't always dramatic, it does tend to be higher, even for a physician loan. So that's the trade-off for being able to put down a lower amount for a down payment. In addition to a potentially higher interest rate, there's another thing that comes into play if you put down less than 20%, and that's private mortgage insurance, or PMI. Similar to what I just mentioned, when you put down a smaller down payment, the risk is higher for the lender. So in addition to potentially charging a higher interest rate, the The lender will also make you pay for insurance that helps protect it if you default on your loan. So this is another item that raises your effective cost as a borrower. Another thing to consider with the size of your down payment is the size of the mortgage. If your mortgage is above a certain size in total dollar terms, it's considered a jumbo mortgage, which, continuing along the lines of what I just discussed, means it's a riskier loan for the lender, and therefore the bank charges a higher interest rate to compensate for that risk. And this difference in interest rates for a jumbo mortgage can vary, but it's typically about 0.25% or 0.5%. So maybe instead of paying a 3.0% interest rate, you end up paying 3.5% instead, which may not sound like a lot, but that can really add up over time. The dollar amount that makes a mortgage a jumbo loan varies depending on where you live. For example, in Michigan, for 2021, that number is $548,250. But in other higher cost areas of the country, that number can be more than $800,000. So for the purposes of our discussion, the point we want to make is that if putting 20% down can reduce the size of your mortgage and put it below the jumbo cutoff, that's another reason for doing it because it's going to further reduce your interest rate and the cost of your mortgage. Apart from the cost of the mortgage, another reason we like the 20% down payment is because of cash flow considerations. In basic terms, the larger the dollar value of your mortgage, the higher your monthly payment is going to be. So by putting down a higher down payment, you're able to reduce the size of your loan, reduce the size of your required monthly payment, and give yourself more cash flow cushion each month because a smaller amount of your income is going toward this fixed expense. To provide some context here, if you look at a situation where two people are buying a $750,000 house and one of them puts down 0% while the other puts down 20%, the mortgage payment for the person putting down 20% would be more than $8,000 less on an annual basis. So that's an extra $8,000 in cash flow for them each year that could then be used wherever they want, whether that's saving and investing or spending. So that's the rationale for putting down the traditional 20% down payment, but we also want to share the case for putting down less than 20%, just so you can understand the full picture.
Yeah, and the first thing to mention here is simply the reality of life and career stage. While it's nice to be able to put down 20%, we know that for some physicians that just isn't an option based on the timing of when you want to buy a house. If you're a first-year attending looking to buy your first home, you may not have been able to save up enough for a 20% down payment during training. So that's the more obvious reason for putting down less than 20%, the simple reality or necessity of the situation. However, another reason is looking at the decision from a financial perspective. When it comes to the purely financial side of managing your cash flow and savings to optimize your situation, the first question to ask is, what's the best use for each incremental dollar? So within the context of mortgages and down payments, the question is whether you'd be better off using an extra dollar or dollars for a down payment or using that money elsewhere, like paying off high interest credit card debt or saving and investing it. And here it's all about comparing your potential or expected rate of return on that dollar for the various uses. In the case of mortgages, this is pretty straightforward since your rate of return on each incremental dollar put towards your mortgage will be approximately equal to the interest rate on the mortgage. And this is because each incremental dollar used to reduce the amount of the mortgage will mean one less dollar that you're paying interest on. So looking at the down payment decision in isolation, it's relatively intuitive to understand that the more you put down, the less you'll pay in interest and the better off you'd be. However, we know that decisions are rarely ever isolated when it comes to managing your finances, and when deciding on how much to put down, you also have to factor in other potential alternatives for that incremental dollar. For example, if instead of putting down the full 20% down payment, let's say you wanted to put down 10%, and then the other 10% you have was just going to sit in the bank account. Well, you compare the rate of return on that 10% sitting in the bank, most likely earning 0% interest, relative to the interest rate on the mortgage. Going this route, at least purely from a financial perspective, you'd be worse off by the delta, or difference, between the interest you are paying on your higher mortgage and the interest you receive from the cash sitting in your bank account. Which is where you'll see that the opting for a higher amount of debt in exchange for a 0% return isn't a more attractive option financially speaking. However, if the alternative is opting to use the additional money to invest or pay down other debt, you want to think about what rate of return you might earn on your investments or the interest rate on other debt you may have that would be higher, like credit card debt or potentially student loans. As we've mentioned several times in other episodes, historically the stock market has provided roughly a 10% annual return, and bonds have earned a roughly 4 to 5% return. So looking at investing the additional money to earn 10% is going to be the best long-term decision than using the additional money to pay down debt at 3%. Having said that, the caveat is always that there's no guarantee that future returns will be similar to past returns or what will happen in the near term. And following similar logic to investing with an expected rate of return of 10% being better than paying down your mortgage at 3%, it works with other debt you have as well. For example, if you had credit card debt with an interest rate of 18%, you'd be better off using additional money to pay down the credit card debt versus putting more of it towards your mortgage. So if you're trying to decide whether to put down a higher down payment or use that money elsewhere, you want to think about whether you could earn a higher return by investing the money or paying down higher interest rate debt. And given how low mortgage rates are right now, for someone taking out a 30-year mortgage at 3%, the odds are pretty high that over 30 years they would earn a higher average return than 3% by investing that money in a globally diversified stock portfolio. So the punchline here for justifying putting down less than 20% is if you thought you could earn more on your money, or at least had the opportunity to, by putting down a smaller down payment and taking the extra money and doing something else with it, such as investing or paying down higher interest rate debt. But it really is a give and take between the financial side of the equation with what helps you sleep best at night. And we know some people are purely focused on trying to optimize things from a financial perspective, while others care more about the softer and less tangible aspects. So for some people, even if they know there was a better use for their money than going towards a down payment, they may still choose the higher down payment because it feels better having less debt and a smaller monthly mortgage payment. It's all about peace of mind and striking that right balance for you.
Absolutely. And so in addition to the amount you put down as a down payment, another common question that comes up is what length of mortgage to get. For example, a 15-year, a 30-year, etc. And this is obvious, but if you have the same loan amount but are paying it back over a shorter period of time, your monthly loan payment is going to be higher. Also, if you're paying back the loan faster, the total amount you'll pay in interest over the life of the loan is going to be lower, so you'll save money on interest. Additionally, another thing to keep in mind is that when you borrow money, the longer the term of the loan, the higher the interest rate. From the lender's perspective, lending money over a longer period of time is riskier, so the lender requires some compensation for that risk, and that takes the form of a higher interest rate. So big picture, when thinking about the length of a mortgage, the trade-off is going to be a longer mortgage, such as a 30-year, which is standard, that has a higher interest rate, but also a lower required monthly payment, and therefore provides more cash flow flexibility, versus a shorter mortgage, such as a 15-year, which has a higher required monthly payment, but a lower interest rate and lower lifetime interest payments. And we generally prefer the 30-year option for a few reasons. The first is the cash flow flexibility. If you have a 30-year, $600,000 mortgage at 3.5%, your required monthly mortgage payment will be around $2,700. On the other hand, if you look at the 15-year option for that $600,000 mortgage, you might have an interest rate of 3%, but your required monthly payment will be closer to $4,000. On an annual basis, that's a difference in total mortgage costs of $32,000 versus $49,000, which isn't insignificant. Knowing that your mortgage is a fixed expense that must be paid each month, the longer term provides more cash flow flexibility since it's less in the way of required expenses each month. At the same time, you still have the flexibility to pay ahead on your mortgage to pay it off sooner if you'd like. For the majority of mortgages, there's no prepayment penalty. So if you want to make higher than required payments each month to pay it off faster than 30 years, you're still able to do that. You just aren't locked into that higher monthly payment, so you have more options. In the example I just shared, if you went with a 30-year mortgage and decided to pay $4,000 a month toward it, rather than the required $2,700 a month, you'd end up paying it off in about 16 years, so only 1 year longer than the 15 years, but with much more freedom along the way in terms of your options and what you can choose to do. Another reason we like the 30-year option is that interest rates are near historically low levels right now. So even if the interest rate on that 30-year mortgage is a bit higher than the 15-year option, it's still going to be a great rate and really low in absolute terms. Going back to the last point Andrew made about uses of money and putting more toward your mortgage versus investing it with the hope of earning a higher return, even with a 30-year mortgage, your quote-unquote hurdle rate in terms of investment return required to be better off using that money to invest is going to be low. And with the 30-year mortgage, you have a lower required monthly payment and therefore more cash flow that's available each month to invest if that's what you choose to do. So as you can see, a 30-year mortgage offers somewhat of the best of both worlds in terms of balancing interest rate or cost of the mortgage with flexibility and options.
Yeah, and another decision you have to make that ties in with choosing the term of the loan is deciding whether to choose a fixed rate mortgage or a variable rate one. And as the name implies, a fixed rate mortgage means that the interest rate is set for the life of the loan and it doesn't change regardless of what's happening with interest rates. Your other option is a variable rate mortgage, which is also known as an adjustable rate mortgage or an ARM. With an adjustable rate mortgage, there are typically several options, like a 7 or 10-year ARM. And to avoid going too far in the weeds here, the way these adjustable rate mortgages work is that you have a set interest rate for a certain number of years, like 7 or 10 years. But after that set time period, the rate is subject to changes depending on where interest rates are at. And it's worth noting that the 5-year or 7-year period for adjustable rate mortgages is simply the period before the interest rate resets. It doesn't mean that you have to pay back the loan within that period of time. The loan payments are actually calculated assuming a 30-year payback period. It's only the interest rate that changes. Now, this setup could work either for you or against you. If interest rates fall between when you take out the mortgage and when you have the first interest rate reset, your interest rate will decline and your required payment will decline. On the other hand, if interest rates rise, when your loan resets, the rate will also rise and your payments will increase. So as you can see, there's more variability or uncertainty for the borrower. So in that sense, a variable rate loan is riskier for you as the borrower, especially when looking at longer periods of time and where rates are at currently. Because of that, we generally prefer fixed rate mortgages because of the visibility they provide. you know exactly what your interest rate and monthly payment will be throughout the entire life of the mortgage, so it allows you to plan better. The exception to that is if you know you're only going to be living in the home for a shorter period of time. Let's say you know you won't be living there for more than 7 years. If that's the case, you could look at options for a 5-year or 7-year adjustable rate mortgage. If you find that they're lower than the interest rate for 15-year or 30-year fixed rate mortgages, the adjustable rate could be your best option because you know you'll be selling the house before the interest rate reset date comes. So in that sense, you have visibility of your interest rate, and if it's the lowest one, that'll save you some money. So there are select cases where the adjustable rate option makes sense, but for the vast majority of people, we prefer fixed rate for the visibility and certainty.
All right, so one last thing we want to discuss when it comes to deciding on the details of your mortgage is whether to escrow your property taxes and insurance. What escrowing means is that rather than paying your property taxes and homeowners insurance premiums in lump sum or one-off fashion as they come due each year, you instead break the payments into monthly installments and pay them into an escrow account each month with your mortgage payment. Then, as the bills come due each year for these items, the money is available in the escrow account to pay them. So it's basically a decision of whether you want to smooth out these costs month to month or pay them in a lumpier manner once a year. And here it comes down to personal preference, but we generally prefer the escrow approach because of how it helps smooth monthly cash flow. Most people tend to look at and plan for their expenses and income on a monthly basis, so smoothing these costs out makes it easier to manage them, rather than having to come up with a large amount of cash once a year and having to make sure that money's available. The downside to escrowing is that you give up control of the money sooner, since there's always an alternative use of money and you could be earning some return on it, even if it's just 0.5% in a high-yield savings account. In theory, the financially optimal approach would be holding on to the money for as long as possible, then using it to make your property and insurance payments when finally required. In that sense, it's similar to paying taxes in how the quote-unquote optimal approach might be to have lower tax withholding throughout the year and wait to make your required tax payments until you file your taxes on April 15th. But most people don't like owing taxes come tax time, even though it's the same amount of money that's ultimately paid to the government, the only difference being the timing of it. So escrowing property taxes and insurance premiums just makes things easier. And we're all about keeping things simple when it comes to managing your finances.
Yeah, so that covers the main components you want to understand about mortgages and all the key decisions that go into choosing the right one on the front end. However, we know that while some people may be buying a house at any given time, many more people already own a house and have a mortgage they're paying. So we'll shift gears and talk about some of the key things in this scenario. And the biggest potential financial planning opportunity for anyone who already has a mortgage is refinancing their mortgage. Refinancing your mortgage consists of taking out a new loan and using the proceeds to pay off your prior loan. Now, there are several reasons why you would refinance your mortgage, but at a basic level, it's all about trying to pay the least amount of interest over the life of your loan based on your unique situation and circumstances. For example, let's say you have a 30-year mortgage at 3.5%, but the average interest rates for a 30-year mortgage is now at 2.75%. At first glance, you may not think 0.75% is all that much of a difference, but looking out over 30 years and how your mortgage is often the largest amount of debt you'll have, the savings and interest can be quite substantial. There are different options for refinancing, but most commonly, you take out a new loan with the same value as your existing loan. However, there's also something called a cash-out refinance, where you take out a new loan with a higher value than your existing loan. So once you pay off your existing loan, there's still additional money left over that you can use for whatever you would like. This can be a great option for financing things like home renovations, especially if you're able to lower your interest rate in the process. Though keep in mind the amount of money you can borrow for a cash-out refinance is based on the value of your equity in the home, or the difference between how much the home is worth and how much money you owe on your existing mortgage. However, like I said, the most common refinance is taking out a loan with the same value as your existing loan, but at a lower interest rate. And in general, interest rates have fallen significantly in recent years and are near historically low levels. So anyone who took out a mortgage or even refinanced more than a couple years ago likely has potential to reduce their interest rate even more. Lowering your interest rate lowers your required mortgage payments and lowers the amount of interest you'll pay toward the loan over its life. So a common initial question often comes with, well, what's the catch? And there isn't a catch per se, but one thing to keep in mind is that unlike refinancing student loans, there is a cost when you refinance a mortgage. Similar to when you first take out a mortgage, there are costs involved, such as appraisal fees, title insurance, and loan origination fees charged by the bank or mortgage lender. These are referred to as quote-unquote closing costs, and the person taking out the mortgage, or refinancing, is required to pay them. The amount varies by lender and location, but these are often somewhere around $2,000 to $3,000. With that in mind, the trade-off is weighing the cost of refinancing with the benefit in terms of the money you'll save in interest over time. When you refinance, you know you'll save a certain dollar amount of interest each month, so it's a pretty straightforward calculation of figuring out how many months it'll be until the cumulative dollar value of the interest saved outweighs the initial upfront costs of refinancing. And this is often referred to as the break-even period, and once you know it, you can simply compare it to how long you're planning to be in your home. As an extremely simple example, let's say you look at refinancing your mortgage and understand that it'll cost $2,400. but doing so will save you $100 per month in interest. Well, you can divide the cost of refinancing, or $2,400, by the monthly interest savings, $100, to understand the break-even period for doing this, which is 24 months. All else equal, if you're planning to live in your house for more than 24 months, it makes sense to refinance your mortgage, at least from a purely financial perspective. So as you can tell, the earlier on you are in paying back your mortgage, the more the numbers work in your favor of refinancing, since you have more years to capture the benefit of the lower interest rate. However, refinancing can even make sense much later in the process of paying back your mortgage if the difference in interest rate is large enough. When talking about interest rates, some of the differences might not seem that large. As an example, let's say you have $400,000 remaining on your mortgage that is set to be paid off over the next 20 years at an interest rate of 3.75%. Well, if you're able to refinance and lower that rate to 3%, you'll save around $37,000 of interest over the life of the loan. So the benefits can really add up over time, even with the seemingly small changes in interest rate. And one thing to mention when looking at refinancing options, it's often a good idea to check the interest rates from 2 or 3 mortgage lenders. Typically, if you simply take the first offer from your existing lender, it won't necessarily be the best offer. There's no downside to doing this, and if you can find a lower rate from another lender, your existing lender will likely be willing to match that offer to keep your business. And if not, you know that you can always just switch mortgage lenders to the one with the lower rate. We know each person is different in terms of how much time they want to spend shopping for rates, but a quick comparison like this shouldn't take too much time and could end up saving you a lot of money in the long run.
Well, that covers everything we wanted to share when it comes to mortgages and refinancing. We know it can be a confusing topic with a lot of moving parts, and we did get a little bit into the weeds with some of the discussion and details, but we wanted to touch on everything, and hopefully that was helpful in providing some context around the different aspects and some of the decisions involved. And just to give a quick recap of the different areas we covered. Number 1, when deciding how much to put down for a down payment, we prefer the traditional 20%, but you'll want to weigh the interest rate and cash flow benefits of putting down 20% with your alternative uses of money, such as investing or paying down other debt, as well as your ability to come up with the 20% down payment, especially if earlier in your career. Number 2, when choosing between a 30-year loan term or a shorter term, such as 15 years, we prefer the 30-year option, but you'll want to weigh the higher interest rate for a 30-year with the cash flow flexibility and options that it provides. Number 3, we prefer fixed-rate mortgages for their visibility and certainty, but if you're planning to stay in your home for a shorter period of time, you can look at an adjustable rate option to see if one offers a lower interest rate for your time horizon. Number 4, whether or not to escrow your property taxes and homeowners insurance is really a personal preference, but choosing to do so can be helpful for smoothing month-to-month cash flow and eliminating the need to come up with lumpier amounts of money. And lastly, number 5, if you have a mortgage that you've taken out more than a couple years ago, whether that's your original mortgage or even a refinance, it's worth looking into your options to refinance it and lower your interest rate. Compare the cost of refinancing with the monthly interest saved to calculate your break-even period in terms of how many months it would take for the refinance to pay off. Well, thank you, as always, for joining us for another episode of the show. You can find the show notes and links for the episode at mdwmllc.com/podcast. And if you have thoughts to share or questions you'd like answered, please email us at info@mdwmllc.com. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.